The great investor Warren Buffett once said, "It's good to learn from your mistakes. It's better to learn from other people's mistakes." So in this video, we've compiled a list of 7 common mistakes which other investors usually make. You can learn from these mistakes and avoid them while venturing out in the world of investing and have an edge over the competition. So without any further delay, let's dive straight in. Hello everyone and welcome to our channel Money Invest. We bring you information about investing, passive incomes, and lessons from investment gurus like Warren Buffett, Ray Dalio, Charlie Munger, and many others. So don't forget to subscribe to our channel and don't forget to press the bell icon so that you don't miss out on any of these awesome content. Number 1, not doing the research. We all have that friend, don't we, who just sees a new trend entering the market and goes all in without studying the prospects of that business. A few months later, either that business flourishes or sinks down into oblivion. That's gambling. It's a recipe for death. You wouldn't want to do that. No, you wouldn't want that. You need to exercise control, and for that you need to know the ins and outs of the business before investing. What are the future plans of the company? Are those plans viable? What are the competitors up to? Many greats have become great in investing due to this key factor. They do the homework, and those who don't have to deal in losses. A perfect example for this is billionaire Ray Dalio. In his book, Principles, he mentions that when he got into the livestock, meat, grain, and oilseed markets, he learned about each and everything in the aspects about them. Since livestock mostly eats corn and soy meal, he learned just about everything imaginable about them. Why? So that he does not leave behind any variable that would even have the slightest effect on his investment. That's the kind of determination you need to build. Number 2, trying to time the market. If you have spent some time on the internet trying to figure out the basics of investing, you must have come across some random people blurting out, "Buy low, sell high," or "I just know how to time the market." Beware of such shallow pieces of advice. That's a slacker talking there. Many prominent figures have debunked the myth about timing the market. It's just something that doesn't work. The economist and Nobel Prize winner Paul Samuelson is one of the prominent ones. He, in the Journal of Portfolio Management, in the year 1994 said that the investors who try timing the market don't do better than those who keep about 60% of their money in stocks and remaining in bonds. And what's the best approach? Experts recommend keeping a portfolio that's relatively independent of the overall market and that doesn't attempt to beat a particular index. Number 3, confirmation bias. We humans are born with a fault. Too many biases, and these things cloud our brains and make us commit dumb mistakes. And when it comes to investing, the most common of them is confirmation bias. Let's take an example of a person who's always on with a pair of blue lenses in their eyes. Anything that they see appears blue to them. Will they be able to see colors as we look at them? Absolutely not. This is what happens when a person is held back by his own pre-existing ideas and convictions. This is what confirmation bias is. In investing, you may think a particular stock is not doing well, or rather it won't do well. You might not know the reasoning behind your deduction. You just think so and end up slipping by a golden opportunity. How to get over confirmation bias? Well, you can start by asking the question, what if I'm in the wrong here? Not trying to immediately jump into conclusion and trying to build multiple hypotheses. If you take such steps, you're more than likely to avoid confirmation bias. Number 4, recency bias. This bias refers to the tendency to act in haste due to some recent or older news. Examples of this bias can be found everywhere. When Elon Musk tweeted out that Tesla will start accepting Bitcoin as a mode of payment, there was a steep rise in the value of Bitcoin. And when he announced that they were going to halt accepting Bitcoin, the price of Bitcoin toppled down like a pack of cards. This clearly exhibits recency bias. Most of the people who opted in the first place and those who opted out in the second case didn't have clear motives as to why they wanted to invest in Bitcoin. They were the puppets of FOMO. This ties in well with the first mistake we mentioned, which was not doing research. This can be easily avoided by having clear motives as to why you plan on investing into some business. Number 5, loss aversion. Loss aversion is a tendency in behavioral finance where investors are so fearful of losses that they focus on trying to avoid a loss more so than on making gains. The more one experiences losses, the more likely they are to become prone to loss aversion. Research on loss aversion shows that investors feel the pain of the loss more than twice as strongly as they feel the enjoyment of making a profit. The most common example of loss aversion is investing in low returns guaranteed investments over more promising investments that carry higher risk. The most dangerous form of loss is when investors don't acknowledge a loss as being such until it is realized. Therefore, to avoid experiencing the pain of a real loss, they will continue to hold onto an investment even as their losses from it increase. This is because they can avoid psychologically or emotionally facing the fact of their loss as long as they haven't yet closed out the trade. In their subconscious, if not their conscious, thinking the loss doesn't count until the investment is closed. The negative effect of this, of course, is that investors often continue to hold on to losing investments much longer than they should and end up suffering much bigger losses than necessary. That's what loss aversion looks like in practice. Well, how do you guard against the loss aversion bias? One particular step is to always use firm stop-loss orders to minimize your potential loss in any trade. Stop-loss orders basically set a limit below which you won't hold the stock and in a way save you from leaving with an empty hand. Number 6. Not investing in themselves. Warren Buffett reads 6 hours a day. Almost all of the great minds we see around us soak in knowledge like it's their last day. And that's where most of the other people lag behind. The world is dynamic. New innovation occurs on a daily basis. And it's important to inquire about the knowledge so that you can be perceptive about the next big change. Charlie Munger, Warren Buffett's business partner, suggested attaining fluency on the big, multidisciplinary ideas of the world. What are those big multidisciplinary ideas? These are mental models which help us understand the world better. Think of them in this way. You have a bunch of beads in your pocket. They are worthless unless you join them using a thread to make a necklace. These mental models are the thread, the latticework of theories which help you connect two completely different ideas together and make connections. They help you see the bigger picture. And it is just not about ideas and knowledge, it's also about mastering skills such as storytelling and presenting yourself. If you wouldn't be able to present yourself and express your ideas effectively to others, you might just not get the big opportunity you deserve. Warren Buffett once said in an interview that the business school graduates get too busy learning about the complex formulas. If they just learned to communicate better, they would improve themselves by 50%. So it's important to imbibe such skills into yourself. Number 7. Not studying the past. Ray Dalio in his latest book writes, "The really big boom periods and the really big bust periods, like many things, come along about once in a lifetime. So they are surprising unless one has studied the patterns of history over many generations." This is a widely missed point. To understand what's currently happening, one has to look in the past. But since this doesn't seem intuitive, especially in investing, most people tend to ignore this factor. But this is a grave mistake. For instance, the two of the greatest financial catastrophes in the past century and the Great Depression of 1929 and the Great Recession of 2008. To an amateur, both incidents may appear to be distinctly different because of the two different eras. But the trained expert knows better. They understand that both catastrophes had striking commonalities, and the expert studies both of them and finds patterns and prepares for the worst. If patterns of such a crisis appear in the future, the expert will easily spot them and adapt their strategies accordingly, while the novice remains oblivious to the impending threat and faces heavy losses. So don't just ignore the past. And with that, we come to the end of our video. Comment down below and tell us what you think the other common mistakes which investors make are. Make sure to like and share the video and subscribe to our channel, and we'll be bringing you lots more videos about investing. Make sure to press the bell icon so that you don't miss out on any of our awesome content. I'll see you soon with another awesome video, and until then, take care.